Welcome to the current federal tax developments here for the week of May the 21st, 2018. Current federal tax developments are brought to you by Kaplan Professional Education and your state society of CPAs. This week, I've just gotten back from a trip, so if any of you who tend to pick it up on the weekend when it's posted probably noticed it didn't go up when normal. That's because I spent Saturday coming back from Newark, New Jersey, flying back to Phoenix, stopping in Austin, of all places, to change planes. So I spent most of the day on planes or in airports, so we didn't quite get this posted yesterday. But we are going to try to get it posted here on Sunday, and certainly it's going to be available. Those of you that usually pick it up Monday, you're not noticing anything's different. So we'll go for that. Things we're going to talk about this week, we're going to talk about some updates on Tax Cuts and Jobs Act guidance that we saw at the American Bar Association tax section meeting. We'll discuss the case of an individual who had tax due on a tuition waiver he received as part of a severance package he received 22 years earlier for his daughter, who very possibly wasn't even born at the time, who managed to use it, and that created a taxable event. We'll talk about Connecticut becoming the most recent state to pass a SALT workaround, and actually a pair of them. We'll discuss kind of where we stand on those workarounds right now. The IRS updated the revenue procedure for information, whether you can rely on information from the IRS about the status for deductible purpose of a charity. And we're also going to look at a case of a taxpayer who claimed they relied on the advice of a professional and shouldn't be penalized. But the tax court didn't go along with their view on that point. Let's start with that American Bar Association tax section meeting. And this was a meeting of the American Bar Association tax section. It actually took place on May 11th and May 12th of this month, right? So we have it. And we have articles that came from tax analysts that discuss this, along with some other information received from other sources. A number of the tax press came out and covered the American Bar Association meeting because a lot of the IRS individuals and a lot of Treasury people are going to be involved in guidance for the Tax Cuts and Jobs Act were going to be available and speaking at that location. It's kind of helpful. We discovered, at least remember years ago when I was involved with the American Institute's tax section, what we discovered was that basically anytime you had a thing in Washington, it was much easier to get the Treasury people to come by. It was much more difficult to get them to commit to going somewhere on the road. And then secondly, that was before all the travel restrictions came in play. So this was a much anticipated meeting. And unfortunately, while much anticipated, it really didn't tell us a whole lot we didn't already know. A lot of what we were told at this meeting tells us that the guidance we're going to be looking for, at least the earliest parts of it, are going to come out in midsummer. We did have an update to the IRS's priority guidance plan that was updated just before this program began. And according to that, the 199 Cap A guidance is supposed to be released prior to June 30th. Okay, they kind of wavered a little bit on that date at the conference, so late June, early July is when we plan to see the proposed regs. But a concern that arose there was that at the conference, the IRS refused to indicate if these regs were going to be issued in a way where taxpayers could rely on them. Now, that's important because proposed regs are an odd beast. You know, temporary regulations you can rely upon, even though they're not permanent, they don't exist forever. And they're kind of, in one sense, a lower class than we should call proposed regs. Proposed regs are going through the formal process to become final. Nevertheless, you can rely on them. Temporary regs, I should say temporary regs are for, we have some reliance if we issued those. But proposed regs, generally, unless the service tells us we can rely on them, then, it's kind of up in the air. Now, obviously, we still need to interpret these provisions and make use of them in some way, shape, or form. And the temporary regs would be one interpretation, and lacking any other interpretation, we'll, have to go with maybe the proposed regs, or at least that's one option. But the IRS quite often says taxpayers may rely. They protect you because nothing says the IRS couldn't disavow this position, or even in the final regs go back and change the rules and say that, no, this is what we're doing. And the proposal was just an idea, but here's the real thing. And right now, the IRS is not committing on any of these regulations to issue them in a form where we're going to be told we can rely upon the regulation. They might not. And actually, that's part of the takeaway at this conference. The IRS was being the IRS and Treasury, to be honest, were being very cautious about not giving away anything. This is very different from what we saw at San Diego back in February, the last Bar Association tax section meeting, where we got lots of information from the service about things that were happening. Now, some may wonder and worry that maybe part of the reason why we're not seeing this now is A, they just saying we're close enough to the break, so don't issue anything. And B, one of the individuals that we got the most information from at that conference ended up being dismissed, leaving his position. He may have resigned, but it wasn't exactly, resigned because he just felt, oh, this isn't for me. It was resigned more because, apparently it was felt that he was causing some controversy and he was an appointed political position. So it appears this time everybody just said, nah, we're not saying anything. I don't want to risk my position to come out here and say something. So what we heard was a lot of reiteration of what we had been told in San Diego. One of the things that was repeated, and this is important because we got this back in San Diego from the individual who then got dismissed, was they did say that, no, the IRS is not considering expanding reasonable compensation under Section 199 Cap AC4. They're not considering expanding that to cover things other than S corporations. For those of you who don't just have the code memorized, that particular provision in the new qualified business income deduction rules was the one that said that qualified business income shall not include, and then it listed things. One of the things it listed it does not include is reasonable compensation for the taxpayer in the trade or business. Normally, most of us would seem to suspect when reading that reasonable compensation normally goes with S corporations, but the actual law never said S corporations. And that caused people some real concern. Would the IRS say, well, we're going to come up with a reasonable compensation calculation for partnerships and for sole proprietorships. And to the extent rentals work, we'll come up with one for that too. And you won't get the 199 Cap A deduction on that amount of the earnings. And the IRS again assured everyone at this meeting. In this case, it was Kathleen Reed, who is the Branch 7's chief of the IRS Office of Associate Chief Counsel, Income Tax and Accounting, essentially said that, and actually, nope, I misquoted her. She is the one that's going to give us a quote on bonus. In this case, it was Brian Rimke, who was also in San Diego, who basically said that, yeah, don't really worry too much about this. The other key issue, we did have some discussion here. Kathleen Reed did talk about the fact that we're going to have the bonus depreciation regulations come out, but again, refused to commit to say that we're going to be able to rely on those. In that case, it's less of a problem because what we have is, for the most part, not entirely, but for the most part, we just have a change in the amount of the reasonable compensation. We do not, or I should say, amount of the deduction. So we go from 50 to 100%. We don't have a change in a lot. We do have a change in a few, but not a lot of definitions. And we do have a change to go from no longer having to worry about we have not previously used it, or let's say it had not been previously used by someone else, to just that we had not previously used it. Obviously, there's going to be some guidance about what we and related parties mean there, but otherwise, most of the bonus seems fairly straightforward. The old guidance will help cover us. So we're going to be in pretty good shape there. We have the other discussions. There's really, as we said, very little other information. The real takeaway of this is that probably we're waiting for these early summer guidance. And even though the IRS is saying that we may not necessarily be able to rely on that guidance, my guess is for a whole lot of issues, we're going to have to start kind of working toward whatever guidance comes out. If the IRS does not tell us we can rely, certainly you do not want to do anything that you can't undo by the end of the year. But if you're just trying to project numbers and do estimated taxes, probably the proposed regs, even without the reliance paragraph, will be good enough for now to try to work up some basics and probably will get you close. But in any event, stay tuned over the next couple of months. Hopefully, we'll begin to get at least some more official indication of the answers the service is going to give us on issues like how qualified business income works, what counts, what doesn't, all those things. Oh, I should add one other thing. They did tell us one little piece of information that was kind of useful. They told us at the meeting that they are not planning to backport the guidance they will give here for qualified trade or business, a specified service business, they won't necessarily take that back and use that for 1202. Remember, a lot of our specified service businesses are things that don't qualify for 1202 treatment. Well, we've had almost no guidance there. And so the question became, well, if we're going to issue it here, because now we have to, this covers a much wider swath of taxpayers. Would that guidance count for 1202? The answer is not necessarily. There is no intention to just backport this and drop it in, or even backport it all the way to the basically to the service businesses rules, the personal service corporation rules, which actually cover a lot of the first few of the 1202s. They're saying these are all different sections for different purposes. The terms could, but won't necessarily have different meanings for each one. So just be aware. If you thought maybe you'd get some 1202 guidance by waiting for 199 Cap A, you might be disappointed. Next up, let's talk about the case of Voigt versus Commissioner. Tax Court Summary Opinion 2018-25, issued on May 14th, 2018. This covers the saga of John Voigt. No, not the actor, different John Voigt. In this case, this Mr. Voigt left his job at Tulane University 22 years ago. Okay, it was part of a cost-cutting move at the university. The university was having financial difficulties. They brought in outside consultants. The consultants gave recommendations about certain departments where certain people should be cut. Mr. Voigt was in the IT department. He was in a supporting role, and his job was eliminated. As part of his termination package, Tulane University gave him the right to continue to qualify for a tuition waiver for either himself or any of his dependents. In essence, open-ended. This would go all the way forward. And he or his dependents still had to register at Tulane, and obviously had to qualify for admission. They had to be admitted. They didn't say, yeah, we're going to admit you no matter what. I don't care if you've got an SAT of 0. We're going to admit you. You got an SAT of 0 and your high school GPA was, the barely passing in order to get out of high school. No, we're not going to say we're going to admit you based on that. But, if you do get admitted, we would waive your tuition. 22 years later, his daughter, who likely wasn't even born when Mr. Voigt was laid off of Tulane, received a tuition waiver that was tied to that severance package. Now, John was fine, except at the end of the year, in January, out of the blue, his employer from 22 years ago sent him a W-2. And John was like, what's this? I didn't do anything for you, which, by the way, he didn't. And Tulane said, well, doesn't matter. The tuition waiver your daughter got a benefit from was related to your service here at the university 22 years ago. And John said, but wait. Under Section 117, I'm sure John didn't say under Section 117, but I'll say under 117, tuition waivers for employees and their dependents aren't taxable. And Tulane said, well, but you're not an employee. And John said, what do you mean not an employee? Send me a W-2 for wages to an employee. And Tulane said, well, sorry, that's merely for purposes of issuing the W-2, but your actual service as an employee took place 22 years ago. So John said, well, then I should have been taxed on it 22 years ago, right? That's when it occurred. Well, obviously it was a dispute. John did not report this income on his return. The IRS noticed the W-2. And so the IRS came to John and said, you owe us tax on this. John said, no way. I haven't worked for them in 22 years. So if it was taxable back when they let me go. Number two, okay, even if you tell me that for some reason it's taxable today, that we should count it today. And even if you don't buy this theory that, look, it's a W-2, so I'm an employee this year. Okay, you don't accept that. But bottom line, under 117, I should be able to exclude from income this tuition waiver because it was an employee benefit. Okay, let's deal with each of his arguments in line. The tax court looked at each one. First thing they looked at was, what about 22 years ago? Well, the tax court said, yes, this was for services rendered 22 years ago, and yes, the severance agreement was signed 22 years ago. However, This is cash basis. And actually, in this case, it probably doesn't matter. But for now, let's go with that line because it'll work for 99.999%. We don't have to worry about this theoretical whether an accrual basis one might have had to pick something up or not. Probably not, but still. They said, look, here's the problem. You received it when it's taxable to you as an employee is when you receive your payments. And when you receive your payments is either when they are actually received by you or when they are constructively received. Now, actual receipt, there's no question. You didn't actually get this benefit until your daughter had tuition waived, which was last year. So, John, tough luck. That'd be actual. So your only issue is constructive receipt. And the court said, well, this doesn't qualify as constructive receipt. It wasn't an everything's over but the shouting and you could have just gotten this money at any time. Rather, there were very specific conditions that had to be fulfilled for you to get the benefit of this waiver. First, you or your dependent, and his daughter, obviously 22 years ago, probably either wasn't yet born, or even if she was born, I suspect she probably wasn't going to college anytime soon. It actually helps to be able to walk and talk in order to be able to go to college. It's a little helpful if you've at least managed walking, talking, reading. A few other skills are kind of helpful. So, a 6-month-old infant is going to have a little trouble making it at Tulane. So he said, we still had to wait for that event. There was no guarantee that either you or your dependent would be admitted or that you or a dependent would ever register at Tulane. In fact, probably back then, there was not necessarily any dependent. So the problem becomes, John, you didn't constructively receive it. Okay. Well, what about this thing? It's a W-2. I'm an employee this year. The tax court said, no, you're an employee. You only got a W-2 because you received payments related to work as an employee. But you have not been an employee for years. Those wages relate to your work to 22 years ago. So you're not an employee this year. So you can't get the 117 exclusion by saying you're an employee. It was given to an employee. Well, but what about the secondary one? It says the other reason I can get it is either an employee or a retired employee. And this cross-references definitions under 132. And he said, well, I was laid off. I stopped working for Tulane. Isn't that like retirement? Tax court said, yes, we agree that this section, 117, doesn't really describe, and neither does 132, define retirement. But the court said the general definition of retirement is when you're at the end of your career and you're ceasing work, or at least ceasing in that area. And he said, John, you went on and you worked for all these other entities over all these years. All you did was stop working for Tulane, but you didn't stop working or end your career. Tulane did not basically, you didn't leave Tulane because you were slowing down, you're stopping your career, you're retiring. You left because Tulane didn't have money, and you were part of a money-saving routine for Tulane. So that doesn't count. You're not a retired employee, so you can't get the benefit based on being a retired employee. So basically, John, here's your problem. This benefit, which would not have been taxable had you been working for Tulane, would not have been taxable had you exercised it immediately back 22 years ago. It's taxable this year. Currently taxable, tax due on the payment. It's kind of an interesting analysis because remember, with employee benefits, many cases we have things that are taxable or only tax exempt if received by an employee. If you have a benefit where you extend it out beyond the employment period, you want to be very careful about whether or not it's going to remain non-taxable. Because as Tulane, and by the way, Tulane properly reported this, as Tulane noted here, this was going to be taxable. It was going to be wages when paid. And so it was paid, it was wages. And because he is not currently an employee, all those exclusions that would be allowed because he was an employee, well, those don't work anymore. So John, unfortunately, got stuck with having to pay tax on these numbers. Bad news. By the way, very bad. You fully understand why John doesn't see why he's paying tax on this, but sometimes the tax law just isn't fair. Next up, we have another state adopting a workaround for state and local tax deduction limits under the Tax Cuts and Jobs Act. And, the tri-state area around New York City, we now have all three have now called in with their workaround. In fact, they are the first three to do it. Connecticut's substitute bill, SB 11, on May the 10th was signed into law by Connecticut's governor. This bill adds two different workarounds. The first workaround is much like New Jersey, the local area can set up this charitable fund, you contribute to it, you get 85% of the donation you can get as a credit against your property taxes. So that's pretty much, you may remember New Jersey adopted one. New Jersey's difference is you get 90%. But it's the same basic structure. So, here maybe my local school district would set it up, and they would, or probably in Arizona, if you did it, it'd be like the county, because they collect everything for all those other taxing agencies. They'd receive the money. They would set up this fund. They would specify a charity who would be this fund. It would receive money from everybody, and then it would transfer that money eventually in a grant to the governmental agencies. I would then be able to, when my property tax bill came, reduce my property tax bill by that percentage. Okay. Now, Connecticut also did a second tax quirk. In this case, they're going to apply a tax on the income of every pass-through entity in Connecticut. It's going to be and according to Connecticut, they're going to treat it as a business level tax. Think of it similar maybe to the tax that California imposes on limited liability companies, or that Texas does, their franchise tax. We could say it's a business related tax, right? So it's a business related tax, it's entity level tax. So they're going to have that at the entity level, and then it's going to pass out to the equity holders, shareholders, whoever, a tax credit for Connecticut equal to their share of that tax that was paid. Now, the real question with these, and this second one is new. We haven't seen one like this yet. And in fact, now New York is thinking maybe we should do that. But it's closest, shall we say, to the payroll tax when we discussed with New York. The big question that everybody's going to have to deal with if you're in those areas is, will these work? And the real answer right now, I was talking to a group this week and I made this statement, I still stand by it, that quite often if I ask somebody whether this works or not, ask CPAs, what I primarily discover is their party affiliation, right? It's like one of those things. If they are, let's go with a Democrat, they would say, oh, yeah, it works. Oh, yeah, it should work. Yeah, there's no problem. If I talk to a Republican, it's like, no way, this doesn't work. And if I talk to somebody who's a registered independent, they're like, well, I just don't know. It's like, there's this, there's that, and I have no clue. The answer is right now probably closest to the independent answer. We just don't know how these work. You can read all the articles online, the arguments for, pro, con, etc. I think I've stated myself that I happen to believe that they probably don't work, but then I've always been skeptical about the things that are covered in a lot of other dollar for dollar tax credits at the state level. But the IRS has accepted those informally. The chief counsel advice, that's about as binding as as what they scribbled on your latte at Starbucks this morning. But nevertheless, they have not challenged them in the past. This is where it gets interesting as to how this works. And when we're talking about a tax credit where you get a tax credit that is very close to either that is or is close to entirely the amount of what you gave up, does that work? And if there's a point at which it doesn't, and that old chief counsel advice they keep talking about, that actually says that there'd be a situation where they could conceive it might happen that there could be a situation where a scheme would be just a payment of the state and local tax. Well, now we got to get beyond might be, and we need to kind of define where that break line is, if there is a break line, or simply say, which by the way, the courts could say is, no, it's just, if you get a benefit for a charitable contribution, the law is clear, you reduce it. And yes, we said, don't worry about your tax deduction. Don't worry about the fact that if you make a $100 contribution, you may reduce your state taxes by $5 due to the benefit of the deduction. That's fine. That's okay, because clearly Congress intended that because they allow the federal deduction. But they're saying, but if you're getting a dollar for dollar tax credit, that's radically different than getting a deduction. And they'll probably, and they could very well say, we don't see the distinction. The tax court tried to make a distinction a number of years ago, you may remember, in the Virginia historic tax credit case, when they said, well, if a state intended this to work this way, then even though it normally wouldn't, if this wasn't a state entity, it does. That was looking at whether you could have tax credits in a partnership where there was really no other reason for the person to be there. Could they get their state tax credits, or were their purchases of interest really buying tax credits and taxable to the entity? The tax court said no. The Fourth Circuit said, what you guys been smoking? Basically, they're selling tax credits, and I don't care the state intended them to sell tax credits. They're selling tax credits. We had the Third Circuit then go along in historic boardwalk and said, if it's a federal credit, it doesn't make any difference, same issue. So I'm a little leery about how this is going to go. What we can hope for is some IRS guidance later in the year. If the IRS is going to challenge these, it would be helpful to know right now they're going to be challenged. If the IRS is going to pass on them, then we need to know they're going to pass on them. If the IRS does challenge, then you really got to ask yourself a question of, do you take the position and risk being the party going to court? This is going to be a very interesting set of rules to watch, and we probably are not done seeing states do this. There's a bill currently moving through, as I recall, the state of Illinois that would come with a very similar credit scheme. And we haven't yet heard anything from California. California was early on talking about this, but so far, everything's kind of gotten muddled there. So we'll just have to wait and see. Next up, the IRS clarified how you can rely on whether a charity is eligible to receive deductible contributions. This is Revenue Procedure 2018-32, May 16th, 2018. The IRS updated their procedures for relying on whether a charity, you can receive tax deductible contributions. A lot of us may remember the old publication 76, or 78, I should say, that had a list of charities. I grew up with that in the 80s, 90s, we had that. In 2011, the IRS stopped publishing that list and moved the database online. Now, the problem had been over the years, there have been various other things. There are issues if you have a terrorist-related organization. There are issues if you're giving grants. You may need to worry about whether it's a private foundation. So there have been various ways to confirm the status of your charity. And there were a series of 4 revenue procedures, 81-6, 81-7, 89-23, and Revenue Proc 2011-25, that dealt with how you're supposed to determine if that charity was okay for you to either make the deduction or give the grant to. Now the IRS has come and in this new procedure basically consolidated all of that. This procedure talks about the online databases the IRS has for things such as the list of charities that have received their letter, right? That letter stating that you're a 501c3 charity. That basically takes over for the old publication 78. Remember, though, of course, that some charities, big ones being churches and government units, don't get a letter, so they won't be in that database. But if you're giving to, let's say, like a food bank, you obviously can go there and search for that. They tell you when you can rely on that. General rule is you can rely on it if it's in that list, and the IRS has not yet published a notice saying that it won't be eligible for contributions, right? That's the date when it goes away. But they do have a special rule. They're saying you can't actually rely on that if any of the following are true. You had knowledge of the revocation of the letter ruling, prior to the announcement or posting, because, the charity said the IRS is going to revoke our ruling, revoke our tax exempt status. So you jumped in 50 grand ahead of time. You basically were aware the revocation was imminent. So they haven't yet got their notice they're going to be revoked, but you now know that that's highly likely. So you've got that there, or you're responsible for the transaction that caused the status to be revoked. In those cases, the IRS says you can't rely on those notices. But as long as you're not aware of any of that, they tell you how to do that. This is useful for clients who are making large contributions. You'd like to verify the charity is really a charity. This is also helpful, of course, if you're making grants to help determine how you look that up. So you want to take a look at this Rev Proc 2018-32. It tells us when we can rely and when we cannot rely. But basically, it gives you a one-stop place to go look to determine how do I do this. The databases that are involved, we have some links on the website that will take you directly to those if you've never used those. And otherwise, go into this notice, though, especially if you're talking about big numbers, you'd like to tie down for sure that your client is going to get the result they expect. And this tells you how to get assurance that'll happen. Finally, let's talk about the case of RB1 Investment Partners versus Commissioner. Tax Court Memorandum Decision 2018-64. This one was issued on May 15th, and this looks at whether a taxpayer can rely on advice. This particular case involved a tax shelter that the taxpayers had gotten into. The taxpayers were looking to sell their family business for a really big gain. And, when they were talking about advisors for investing the funds and doing other things, they were eventually referred over to a major law firm, which, the investment advisor said, well, these guys have done things like this for companies. It's a big boy tax deal. So they gone over there, and what they got was a son of boss tax shelter. Now, interesting aside, the son of boss tax shelter, IRS examined those. They said, hey, we don't think this is going to count. The taxpayers, of course, initially challenged that, went to court to challenge the disallowance of the benefit. But things are going bad for you in court when your trial's put on hold because the people who basically sold you the shelter are currently unable to testify due to Fifth Amendment problems. They were under indictment. So, indictment's not conviction, but it's still not going to make you feel real good, right? Okay, ultimately, this trial never started. Finally, they gave up, said, look, we can see the writing on the wall. We've seen all the other cases. We're going to lose on this. So they went ahead and agreed to the tax due that came from the shelter, that they owed all that tax. But they objected to the 20% penalty they were being nailed with. The penalties for this, saying, well, we shouldn't be penalized for this. We had this major law firm that we bought this, that we basically got this wonderful letter from. And it was a standard wonderful letter that when you actually read it and parsed it out far enough, you discovered that it never really said anything much. But still, they were told, the average person does not read that letter. They're just told, oh, here is a letter from the law firm telling you how wonderful this thing is, right? They're saying, well, we got that letter. And then after we signed up for this, we hired, our accountants, our CPA firm, went ahead and prepared the return based on that, and they were okay with it. Well, tax court said, we're going to have a couple of problems here. First, going back to the neonatology case, you cannot rely on advice you receive from a promoter. And this case is kind of interesting because the court actually discussed in a little more detail what exactly would make somebody a promoter. And obviously, if a promoter is shelter under the law, you're going to be. But a key factor they noticed, because sometimes you'll have things that may not be a registered shelter under the law, but you wonder, is this guy a promoter, or they just didn't register? And they're not going to get in that discussion. What they said here was, look, this particular this company's individuals had never paid more than $100,000 for any single legal transaction, including the legal transaction that had been involved in negotiating the sale of their business for big bucks. That involved lots of legal work. They said, but they paid $400,000 to the big national law firm for this package. The court said the law firm gave them the same basic opinion letter they'd given everybody. The law firm really didn't do any legal work on this. They said the law firm was being paid for the shelter. They were not being paid for advice. Because that advice was tainted by the fact that it was basically part of the marketing to sell the shelter. That's kind of the way the law views it. It's like when you're being paid primarily for, giving them the shelter under non-disclosure, this customized shelter, proprietary shelter, you're not being paid for advice. So what you have is a marketing option. They're saying, so therefore, even though they're qualified, no question they were qualified attorneys, we can even say that you had, that you reasonably could expect they should know what they're doing. But that this opinion is tainted by the fact that they're using this to sell the shelter they're not actually selling legal advice. So because of that, while you might have reliance and you might have looked at this and you met the requirements that you had a qualified professional, who was given all information, you don't have good faith, which is what's required. It's not good faith to rely on the opinion of a promoter. That can never qualify as good faith. What about the accounting firm, though? They were not paid. But here's the problem for the accounting firm. The accounting firm's engagement letter said that they would rely entirely on the opinion letter from the law firm. They would actually give a copy of the return to the law firm. The law firm would approve how they were filing the return before the return was filed. And they would not do any independent work to address the issues regarding this shelter. The court said, by the very engagement letter, they said they weren't going to give you advice. And the taxpayer admitted that he wasn't even asking them for advice on this. He was also relying on the law firm, the promoter. So as such, the court said you had no advice from the accounting firm. So while they were qualified, while they had all the information, they never gave advice. Right? Merely signing the return is not enough to show advice was given on the issue. And in fact, I have an engagement letter that says they didn't give any advice. So tough luck. You do not get out of the penalties in this case. Well, it's May. It's mid-May now. And now's the time when you can start thinking about your continuing education courses. I just got back this week from doing sessions, from doing a couple of things. I actually taped some material for our Smart Pros related entity when I was up in Westchester County, New York. And then I came over and did an in-house session for an organization in near Bergen County, New Jersey. And that's one thing I want to remind you of too. You can actually have us come in and do a program for you on tax. If you have if you've got enough people to make sense, to have a group to hire to bring somebody in, that's an option that's available. And you can contact your state society. They can help arrange that with it. And we are perfectly willing to, take a look and perhaps, customize a bit on the topics that are of interest to you. So if you have an interest in anything like that, be sure to contact your state society and do it. If, you're like our firm here, you've got 4 people, then you're probably going to say, yeah, the math probably won't work to hire to bring somebody in. But then, or if you're just, you got a specialized issue, you're the one person who needs to know about 965. The rest of the firm doesn't need to know it. Then you want to look at the products that we're offering through the state society's own catalogs. We can do those, come out to the general offerings that we have, check your catalogs, be sure to look and sign up for them. Again, different ways we can offer your continuing education, different ways to deliver. This has been Current Federal Tax Developments here for this week of May the 21st. You can catch our regular updates at currentfederaltaxdevelopments.com. We'll post there during the week as things happen. If you have any questions or comments, you can send them to me at zollers@currentfederaltaxdevelopments.com. You can follow me on Twitter. I post there at Ed Zollers. I post mainly when I post to the tax blog, but I also post some other things from time to time, so you'll see that there. And you can also follow the discussions on the subreddit r/taxpros. I look in there and I'll follow along on certain things, jump in from time to time. If you have access to the Cal CPA tax, basically tax talk discussion group, I also post there. And by the way, any CPA in the country or attorney can sign up for that discussion group. That's a Yahoo's group. You got to look for tax talk in Yahoo's groups and you have to ask for permission. But if you get in, you can also participate there. With that, hopefully you're having a good early, late spring. We're in Phoenix, so this early summer by now, time of the year. And we'll look forward to seeing you next week as we follow up with more current federal tax developments.